everyone! Welcome back to Corporate Decoder, the place where we dissect company filings to reveal their true financial stories. And today we have a juicy little exchange from Wheeler Real Estate Investment Trust, Inc., a company that seems to be doing some interesting shuffling behind the scenes. So what exactly happened, and why should you care?
Well, in a nutshell, the company swapped some of its preferred stock for more common stock. Sounds simple, right? But these kinds of moves can tell us a lot about a company's financial health and its strategic direction. Stick around as we break down this filing and see what it really means for Wheeler Real Estate Investment Trust, Inc.
Before we dive in, if you love getting straight insights from SEC filings, make sure to subscribe and hit that notification bell. And if you want to join a community discussing these topics and more, check out our Discord channel linked in the description below.
So on the 15th of October 2025, Wheeler Real Estate Investment Trust, Inc., which we'll call Wheeler for short, decided to issue a bunch of its common stock, that is the regular stock that most people own, to an investor.
This wasn't just a handout, though. Wheeler got something back in return. They traded 5,000 shares of their Series D preferred stock and 10,000 shares of their Series B preferred stock for this common stock. That is a pretty significant swap involving different types of stock.
Now let's get into the nitty-gritty of how this exchange worked. The deal essentially stated that for every 2 shares of Series B preferred stock and 1 share of Series D preferred stock, an investor would get 11 shares of common stock. Imagine it like a trade where their preferred stock was the currency to acquire more common stock.
This type of transaction is interesting because it indicates Wheeler might be trying to simplify its capital structure or maybe clear out certain types of debt denominated in preferred stock. The goal here wasn't to get cash, it was to exchange one form of ownership for another.
Why did they do it this way, and why is it important for us to know? Well, companies have to follow strict rules when issuing new stock. They usually have to register it with the Securities and Exchange Commission, telling everyone exactly what they are doing. However, in Wheeler's case, they used an exemption called Section 3(9) of the Securities Act. This exemption is a bit like a shortcut for exchanges that happen directly between the company and its existing security holders. The key here is that WHLR was trading its common stock for its own preferred stock with someone who already owned their securities. They did not pay anyone any fees or commissions to make this trade happen. This is a common way for companies to manage their capital without going through a full registration process, which can be costly and time-consuming. It suggests a strategic decision to alter their equity balance. Now let's talk about what Wheeler is actually listed on. You can find their common stock trading under the ticker Wheeler on the NASDAQ Capital Market. They also have their Series B convertible preferred stock, which you'll see as Wheeler P, and their Series D cumulative convertible preferred stock under Wheeler, both also on the NASDAQ Capital Market. Even their 7.00 subordinated convertible notes due 2031, known by the ticker Wheeler, traded on the same exchange. Having all these different classes of securities listed on a major exchange like NASDAQ signals a certain level of financial sophistication and access to public markets, but also complexity in managing their shareholder structure. Specifically regarding those convertible notes, Wheeler, an important detail is their maturity in 2031. Convertible notes are a form of debt that can be converted into equity, specifically common stock. Having these notes outstanding means Wheeler has obligations to address down the road, potentially through cash payments, interest, or by issuing more stock. The fact that they are subordinated means that in case of bankruptcy, bondholders would get paid after other debt holders. This is a common feature for these types of instruments. Looking at this particular transaction, the exchange of preferred stock for common stock, as reported in this 8K filing, suggests Wheeler is actively managing its balance sheet. The preferred stock they acquired was retired and canceled, meaning it no longer exists as a claim on the company's assets or earnings. This can have several implications. It could reduce the number of future dividend payments the company is obligated to make, especially if the preferred stock paid a high dividend. It might also simplify their capital structure, making it easier for investors to understand the ownership stakes and potential dilution from convertible securities. We did not see any financial tables in this specific filing focusing on the transaction itself. However, the absence of cash proceeds implies this was purely a capital restructuring play rather than a fundraising effort. So what is the big picture here? Wheeler is clearly making moves to streamline its ownership structure. By converting preferred stock into common stock, they are likely aiming to simplify their balance sheet and potentially reduce future fixed costs associated with preferred stock dividends. The reliance on the Section 3(9) exemption indicates a thoughtful and efficient execution of this strategy, avoiding the lengthy registration process for security exchanges. This move signals a company that is not afraid to adjust its capital composition to better align with its strategic goals. What does this mean for investors? For those holding common stock, this exchange could lead to a slight increase in the total number of shares outstanding, which might dilute earnings per share if the company's profitability doesn't grow at the same rate. However, it also removes a layer of complexity from the capital structure and reduces potential fixed dividend obligations.
For holders of the Series B and Series D preferred stock, this was an opportunity to convert their holdings into a more liquid and potentially more growth-oriented security in the form of common stock.
In conclusion, Willer's recent stock exchange is a strategic maneuver to simplify its capital structure and likely reduce ongoing financial commitments. While it involves multiple classes of securities and specific regulatory exemptions, the core action is a shift towards a more straightforward equity base. The company appears to be proactively managing its financial architecture. The strengths lie in its ability to execute such exchanges efficiently and its commitment to optimizing its balance sheet.
A potential weakness or risk is the ongoing dilution for common stockholders if earnings do not keep pace with the increased share count. Overall, this filing paints a picture of a company focused on financial housekeeping and strategic refinement. That is our breakdown of this particular filing from Wheeler Real Estate Investment Trust, Inc.
What are your thoughts on this stock swap? Are you a Weller investor? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description for more engaging discussions. Thanks for watching, and we'll see you in the next video.